We are live in Facebook, and I'm going to make sure that first off, the Facebook page says we are live. And then we're going to start talking. And guys, for those of you who are watching right now, we have a treat today. We've got Jason Wood, known as the VA loan guy. He is a branch manager for American Mortgage Network that ADPI owns a branch of. And we wanted to come in here and start this little series, or just give updates whenever we can on what's going on the front lines with the VA loan. So Jason, please introduce yourself, say hello to our audience, which you obviously know well, but say hello and give us a little intro.
What's up, everybody? I'm excited to be doing this. Hopefully we can get a lot of cool questions and help you guys out with some knowledge and some info. I mean, the group's big enough now where it's hard to kind of stay on top of all the comments and things. So hopefully this is helpful, but just a good way to share some info and stuff. But I'm excited for this, man. The group's been great. I mean, it's grown by leaps and bounds, and everybody's just quality people. I love it. It's great.
Yeah, and so guys, the reason we really wanted to do this, because for those of you who don't know, ADPI has created a financial services division, and American Mortgage Network, our mortgage branch, falls in line with that. And we do these things to provide you with better, cheaper, faster kind of mentality services, and hopefully to give you the best service that we never got, and to give you the best rates that we never got, maybe, and just to kind of cut through some of the fluff out there. So with everything that's changing right now with COVID and with everything else, we thought it was important enough that you guys have kind of the frontline report look at whatever is going on from a loan officer, someone who's extensively experienced in this industry and is constantly day-to-day processing loans, real-time information and all that. So let's just dive right into it, Jason.
Okay.
Well, what would you say what are the most recent changes impacting or affecting the VA loan right now?
Well, the most recent happens to deal with all the COVID stuff, right? So we got the big lockdown, and the stock market went bananas in the wrong direction, and just all this stuff that everyone's aware of. I probably don't need to rehash all of that, but one of the results or the outcomes of that, as far as it affects mortgages in general and the VA loan specifically, is we've seen the minimum credit score increase. So, the VA handbook, if you look at that, it doesn't have a credit score requirement for a VA loan, but most lenders do have a minimum that they
Which is what?
Well, used to be most lenders would go down to a 580 credit score, and it's ratcheted up. Most lenders now are requiring a 660 credit score. Some are requiring a 680.
As the minimum.
At the minimum,
okay.
Yeah.
What were rates, like, just to give the watchers a little bit of perspective? What were the rates at 580 previously? Were those just bad rates? I mean, rates that are tough to even stomach, but you still needed that loan type of thing. And totally. then once you hit 650 or something, it came up, and so now that threshold has gone from 580 to 660.
It has. Yep.
Across the board, or is that a lender specific thing?
Pretty much across the board. I do have, since we're also a broker at American Mortgage Network, we do have one broker resource that will go down to a 620, but the rate isn't going to be something you want to share with your neighbors.
Do you feel like that's something that's going to change over time, go back down to 580, or have we kind of shifted momentum now and people are going to really CYA from now on?
I think it will come back, but I think to get back down to like the 580 level, I think we're probably looking at next year before we see that. And a lot of this new change in rates and credit scores and things like that is a result of how all the economic effects of COVID are impacting the mortgage industry. And part of that is a little convoluted for the general public who don't understand the industry, which is not a surprise, but there's other players involved in the mortgage space aside from like just dealing with me as the loan officer that works at a mortgage company, right? Mm-hmm. Other mortgage businesses that are attached to the industry beyond that. And the most prominent that I'm referring to are mortgage servicers and mortgage-backed securities. And because we had all this economic turmoil kind of happened from this, it has created some issues in those two segments of the mortgage industry, which is spilling over into the front line where everyone's trying to get qualified and get an interest rate and all that stuff. So that's where really the squeeze is right now. And so once we're able to see the slowing of COVID and the actual virus, but moreover like the slowing of forbearances and stuff of that nature, which is directly impacting mortgage servicers and mortgage-backed securities, at that point, then we'll start seeing some loosening up of requirements and rates to a degree and stuff like that.
Okay, so what happens if we end up in a major recession next year? How's that going to impact that? And, you said maybe next year it'll creep up from creep down from where it is now back to where it was at 580 or so. But what if a recession comes? Do we typically see those requirements ease, or do they tighten up if we have a major recession over the next 2 to 5 years?
Well, typically in a major recession, we might see that tighten up. However, the VA loan is unique in the sense that, it's guaranteed by the VA. So 25% of that loan is guaranteed. Statistically, the VA loan is the best performing loan as far as not going into foreclosure for lenders. So it's the most secure loan for lenders to make. Where really the struggle and the fear is coming from right now is the forbearance issue is really probably the biggest thing, because they haven't really figured out how this is going to be dealt with. Because what happens is, when you get your mortgage from a company, most mortgage companies, the lion's share of them, sell the servicing, right? So you do your loan with me, about 30 days after you close, you're going to get some notifications in the mail, and now you make your payment to this other company, right? That's a mortgage servicer. Well, the entity that put up all the money that securitized this was a mortgage-backed security. And for VA loans, it's Ginnie Mae is the mortgage-backed security. And when someone accepts or files for a forbearance, and they don't have to make their mortgage for 6 to 12 months, it saves that person from the economic situation they might be in or turmoil. Right. But what happens down the road is there hasn't been any measures put in place to protect the servicers of the mortgage-backed securities. So every month, whether the consumer is paying for their mortgage or not, that mortgage servicer is required to forward a portion of that payment to the mortgage-backed security. So if we've got hundreds of thousands of people not making mortgage payments, but we have servicers that still have to forward hundreds of thousands of partial mortgage payments.
By forward, you mean pay? I mean, they're essentially paying investors, right?
Yeah, they're paying investors.
Yeah.
So they're now just paying out of their pocket, out of the reserves.
They're just like fronting the money that they're not currently receiving.
Exactly.
Yeah.
Exactly. So that's when that stuff starts to ease, I think is when we'll start to see the credit scores loosen by some of the different lenders and investors and things like that. Because the VA loan is fairly secure. Where we have seen another area that's been a little bit more kind of invasive is just the verification of employment. Mm-hmm. So now, because some people got furloughed or laid off or whatever, there's additional verifications of employment throughout the mortgage process, just because the lenders need to be super duper sure that there's a job at the end of this when they make the loan.
So let me ask you this about forbearance. So like on our apartment assets that we did not even consider forbearance, but on a single family property, I know it's a conversation you need to have with your lender, but what does that mean about the back end? If you go under whatever, if you initiate forbearance, whatever you want to call that term, it just means that, or actually let me ask you, does that mean that month 6 or whatever length of time it is, you owe all of that money that you just put under forbearance? Like you owe 6 months that you didn't pay? Or are they kind of shifting that whole thing, putting everything on pause and adding 6 months to the back end? Which is that? They're essentially adding it to the back end. There was, I think, some early lenders at the very beginning of this when no one really knew what the heck forbearance really meant. And there was no defined explanation for it. I think some lenders were making those payments due at the end of the forbearance period. So if you didn't have a mortgage for 3 months, at the end of 90 days, you owe 90 days worth of payments. Yeah. And that had shifted to be thrown onto the end, because obviously there's no benefit to anybody to just have a buildup of
3 or 6 months worth of mortgage payments. That just puts you in probably a harder, more hardship, right?
Yeah.
So what's been the question mark around all the forbearance stuff though for the consumer is, okay, let's say I do need a forbearance and I do it. What then? Like, what does my picture look like after the fact? And so there's been, the federal government has been pretty cool in the sense that they've ensured that you're not going to have a black market, meaning that you're not going to have credit scores reduced as a result of that. So that's one silver lining of the whole thing. However,
that's not the case.
Well, your score won't be affected, but there's going to be a note on that.
Right. That's what I was going to say. And so what we're hearing in the multifamily space is, and I'm talking about commercial multifamily, is that Fannie and Freddie have a long memory. That's kind of how a lot of people have put it. And so you're saying is Ginnie Mae loans, VA loans, there's going to be a note if you elect to take on forbearance what am I trying to say here if you elect for forbearance and to delay your payments, that Ginnie Mae is going to basically just take note that you did and you weren't responsible enough or capable enough, I guess, at some point. And whether or not that's your fault is not the point. It's that it happened, right? Yeah. Because you could lose your job and need that forbearance, and it's a great thing that it's available. But down the road, okay. So how does that affect that note? How does that affect your ability to get a VA loan down the road?
So mortgages in general, VA or conventional, doesn't matter. We're always looking at mortgage payment history. And so your recent history has a lot of weight in your next loan decision. And so what's going to happen, Fannie and Freddie just announced that they're only going to be requiring you to make 3 on-time mortgage payments after the forbearance period to be eligible for a Fannie or Freddie loan going forward. However, one of our largest investors, I just watched a video on it this morning, they have an overlay to that, and they're going to require 6 months worth of payments be made once you're back into making regular payments from. So
you've got to like season yourself, basically. Exactly. Get back into good standing for 6 months. They can see you have a job, you're capable of paying whatever it is, and then your kind of flag, so to speak, goes away at that point. Okay.
Exactly. And Ginnie Mae hasn't made any kind of announcement, and they may not. They're not quite as newsworthy as Fannie and Freddie, and oftentimes they will follow suit to what Fannie and Freddie do. And I imagine they would probably follow suit to Fannie and Freddie in that regard, but you'll have individual lenders that may have an overlay to that, like the one I mentioned before. And there might be some that maybe have a stricter, or maybe base it on loan size. If you're trying to get a really big loan, they might say, okay, well, let's make sure you've had 12 months of payments first.
Sure. All right. Yeah, that makes sense. I could pull on that one. That one's really interesting. So what would you say to somebody who has so say that someone has lost their job. Let's talk to our military audience, obviously. Actually, say a veteran audience. Okay. Someone who has a W-2 job, they transitioned from the military. They had a W-2 job. They just lost it. Is putting their property into forbearance, is that something you would recommend, or would you say try to do everything you can to possibly not elect to opt into that?
I would encourage you to fight and scrap to avoid that. There's just nothing that's going to help you down the road when there's a look back and they see that you needed a break from your financial obligations. So anything that you can do, whether it's having a garage sale and selling a bunch of junk, or that junky car on the side of the house, or having into savings or whatever, I would suggest you use up all those resources while on the job hunt before tapping into the forbearance opportunity. I had a client, we were working on a refinance, and he called me up and he said, hey man, my lender just called me and offered me a forbearance and I took it, but when do you think we can close on our refi? I'm like, okay, well, if you're going to quit making payments on your loan, the refi is over,
because they're going to look at it and go, well, you don't qualify now.
Yeah. And they don't want to, and the lender wants to make a loan to someone who's just going to file forbearance immediately. Right. So, in this instance, he's active duty. I told him, I'm like, dude, you need to cancel that right away. You have a paycheck.
Yeah.
Paycheck. Like this the forbearance, and here's part of the other thing too. The forbearance conversation is not a vacation from your mortgage.
Yeah, exactly. Yeah.
It's not like, oh, because we got the stay-at-home order, you also shouldn't have to pay for your home, so you can just hang out all day outside. I mean, it's really.
That's why we're having this conversation, Jason, because a lot of people might look at that as an opportunity to stash cash. If you don't have to pay your mortgage payment, I still have a paycheck. Holy cow, I can save 6 months of not having a mortgage payment. But what you're saying, and which makes sense, we've got to educate our community with the investor mindset. And so if you're buying a primary residence or, whatever, if you're buying any home, but it's especially a primary residence, even that, you need to think about that as a potential future investment property and all these ramifications. That's why ADPI exists, honestly, to have somebody have that light bulb moment of, okay, nobody told me that. And so now here you go, Jason, you just told people what they needed to hear, which was forbearance is not a piggy bank, right?
Correct.
It has ramifications on the back end that you as an investor, a potential future investor, do not want to have to deal with. Now, if you have substantial issues with losing your job and you just really need it, that's why it's there. That's why they're offering it, because they understand that it's something that might be necessary. It's either that or foreclosure, right?
Right.
So
in that situation, absolutely. Like I have a neighbor down the road, and their company was kind of a startup company, and this whole thing hit, and they had to file for it, and he's a veteran, but that makes sense, and it was designed for that purpose, right?
Yeah.
And that's going to get enough time to get something else landed and be able to take care of his family and pay for his home, and that was the whole premise for this. But yeah, it's not a piggy bank, it's not a vacation from your mortgage obligation, and furthermore, I mean, think about, what if next year we don't have this major recession? What if next year the economy's kicking butt again? And what if an opportunity comes across your plate, whether it's, who knows, VA rates fall through the floor and you can get a 1.5% ERL, or maybe there's just some amazing investment opportunity, but you took the vacation option this summer on the mortgage being in forbearance, and now this amazing opportunity comes across your plate next February. You may not have the ability to act on it because of that decision, which wasn't necessary anyways. Yeah,
that's great. That is great. I like that we kind of covered that topic there, because I think people are going to understand that now, and not a lot of people are talking about that. So what are you seeing as far as VA loan rates right now? What are we kind of sitting at? I know there's so many variables, and when you see people ask, what's the current rate? Well, the answer is always, it depends, right? But generally speaking, an average loan that's going out right now, like where are we falling?
So average VA rates for conforming loan sizes. So I know that's going to make everyone go to the VA handbook. So conforming is basically defined by the Federal Housing and Finance Authority as conforming loan size is. So basically, any mortgage that is below 510, 400 is considered a conforming loan size, regardless of loan type. It's conforming loan size. So in that bucket, we're seeing
510, 400.
Yep.
What's that? What do you mean? Sorry if I missed
so
that.
That's the conforming. That's like the national conforming loan limit.
510, 400. That's a lot of numbers. What I mean, I'm just
$510,400.
Okay. 510, 400. 510,400. Gotcha. Conforming.
Right. Yeah. So, for example, like if you lived in a place that wasn't a high cost area like San Diego or Hawaii, and you financed more than that, you'd trip into the jumbo loan category. And there's exceptions to that for high cost areas. But my point is, for conforming loan sizes. So, I would say a lot of mortgages are in the high 200, low 300 range, right? So VA rates for that are in the high 2s to low 3s, depending on credit score, depending on property type. So that's where they're ranging. And we locked in a guy today on a purchase, single family home, low 300 loan amount, is a 2.75 with a very small cost to get a 2.75. You could have 2.875 with zero cost, but 2.75 is so close.
That just blows my mind. I mean, it's funny now that people will, and I hear it all the time, and I fell victim to this too, complaining about like a 3.75. But like a couple of years ago, I was like, I got a 3.75 and I had to pay points and all that, and now, I mean, can you imagine that? Like my parents paid like 13 or 15% interest in the 80s for a house, you know, and here we are like 2.75 is like, some people would call that free money essentially, you know? So yeah,
we got so like, I don't know, we're really spoiled. If you look at like the last, I don't know, 7 or 8 years in real estate, we had a couple little spikes in rate, but for the most part, we've had an incredibly low interest rate environment for a long time. Like we're really, really spoiled. And it's funny, like late February, early March this year when we saw the big drop in rates and everybody and their brother went and did a refi. Well, because
me included, by the way.
Because we hadn't hit some of these financial hiccups in the mortgage market that we're in now, everybody was getting a 2.75. It didn't matter if your loan was 800,000 or 100,000. Everyone got a 2.75, and you probably weren't paying any points. And that's shifted a little bit to where that rate is still available in the conforming sizes, but you might have to pay a hair, you know. And we got so spoiled with the fact that, like, well, nope, that's what everyone else got, so that's what I want. And it's like, well, you know, it's not always the same market day in and day out. But the rates are still super, super good. Where we're seeing a little bit of struggle in the interest rate segment for VA is the larger VA loans. So when you cross over that, you know, 500K threshold, the interest rates are not priced the same as they are below that. And that's where today, and if you compare today versus, you know, March 3rd, there's a very big difference in rates for the larger VA loans from then till now. And I think that will begin to start correcting itself as we distance ourselves from the negative impact of the COVID stuff. And, you know, that hasn't all played out yet either. But the further we get from kind of the peak of the COVID hype, the more that will correct.
Yeah. And so you mentioned, you know, kind of a different rate structure, so to speak, for higher price. I fall into that category also too, because I'm in California as well, but still can't complain about my rate. Second VA IRL in, you know, a year and a half or something. As soon as I could do it again, I did it, and I was tracking very closely with you guys. And so, but my question is, what about the differences between condos, single family, and multifamily? As you go from, I know condos is a different thing. Maybe you can talk about that a little bit, but then between single family and our investor kind of constituents at ADPI who want to consider a, you know, house hacking, a duplex, triplex, or quad, what does that financing look like as well?
It's a really good question. So what I try and explain to everybody is interest rate is an illustration of risk. And I think because we've been in this low rate environment for such a long time, a lot of people kind of feel entitled to, I should just have the lowest rate no matter what, because I'm using a VA loan. And VA loan will generate you a lower rate than maybe conventional or whatever. But the fact still remains that there's other factors that still determine your risk level to the lender, right? So every lender has a little bit different tolerance on those topics you mentioned. So condos are usually a little bit higher in interest rate. They're a little bit more risky to a lender than a single family home. And the reason is because you're usually in this community of other like units, very close knit. And if the community as a whole starts not taking care of the property and starts doing things to degrade its value, well, that will affect your unit too. And so it's different than if a single family home 3 doors down, they let the weeds grow up to the windowsills and they don't take care of the home. That may not necessarily have a dramatic impact on your house 3 doors down, but in a condo complex, you know, it's kind of that saying, rising tides lift all ships. And it can go the other way too. So that's why lenders have a little bit of an add-on to rate on condos, because all of them can affect their value and the lien they hold on that house.
Now, while we're on that topic with condos, does it help? It sounds like it would help maybe in a lender's eyes if there's an HOA, and that maybe sound kind of weird, but if there's an HOA and CCNRs, then the tenants in that area are in that condo association are, you know, although they're tight knit and they're packed in there, they all are required to have their house painted on a certain, you know, to a certain standard, and to have the lawn mowed to a certain standard and all that stuff, right? So does having an HOA versus not having an HOA in a condo, does that matter? I mean, I don't even know if there are condos with no HOA, but Probably.
I don't think you'll find a condo without an HOA. So,
Yeah.
but the VA does have to approve the HOA.
Yeah.
So that does make some condos off limits to VA. And we can get them approved, but there's a process they have to go through to check out through VA. Multifamily, kind of a similar scenario, right? There's a different level of risk in a multifamily home. In some parts, it shares kind of what I explained with the condos, right? Like if you have a triplex, you've got 2 tenants and you living there. Well, what if they treat the place really poorly and then the property degrades, right? That's one factor. The other one is, though, from a financial aspect, if that rent coming from those other units is supporting the mortgage payment being made, what if there's a vacancy? What if there's 2 vacancies, right? So that is a risk to the lender, right? Because are you going to be able to make that payment and for how long, right? So there is some additional risk factor there. So we'll see a little bit of a rise in interest rate compared to a single family home because of the risk involved.
So is there a step up, for lack of better words, is there a step up in potential risk or maybe interest rate, generally speaking, from a 2 to a 3 to a 4? Because like if I'm house hacking a duplex, I'm on one side, I got a tenant on the other side, and I can make the payment myself, but I choose to have them renting right on their side. So, but then you go to a triplex, then it's like, okay, I might not be able to cover that mortgage payment on my own. And then a fourplex, which you can still buy with the VA loan for those listeners who don't know that yet. A fourplex, I probably can't cover the entire PITI on my own, right? Or maybe I can, but the lender is going to look at that and go, no, your DTI is way too high. You wouldn't be able to cover that. And that's obviously not a conversation probably they're going to have with you, but they're going to is there a step up from as far as risk and translating to interest rates on a 2, 3, or 4 unit as you go up to a higher unit?
Not usually. From lender to lender, there might be a slight variance in rate between like a duplex and a triplex or duplex and a quad. Usually where you're going to find the change, though, is just because of the loan size, because it's just more expensive to buy a fourplex than it is a duplex anywhere in the country, right? So in your market, that might put you, fourplex might put you over that 500K loan size, and that coupled with the fact that it's multifamily, then yeah, you're going to see a difference in rate versus that duplex that was $350,000, for example.
Okay, so it sounds like to me, if you're going to be house hacking, go big, because the risk is still there either way for as far as the lender's lens. So go to a fourplex if you can, right?
Yeah.
All right. So if you could give one tip for speeding up your VA loan transaction, coming from a loan officer's standpoint, you do a lot of transactions through American Mortgage Network, our branch, as our branch manager. So what is one tip that you would give to somebody to speed up the transaction?
Bank statements. So what I've seen, which has been pretty common with a lot of ADPI members, is lots of different banks and lots of different bank accounts. And then we get into a purchase transaction and we need a little money from this account, we need a little money from that account, we need a little money, and all of a sudden we've got transfers going all over which way. And what that ends up creating on our end is now we have to request documentation on all that stuff, right? So as the consumer, as the home buyer, it's super frustrating to hear from us all the time, hey, I need a bank statement from that account over at that bank for the last 2 months. I need to season this transfer to that account. And yeah,
so showing individual transfers as people are trying to get their money in order. Just for clarity, maybe they don't know that every transfer that comes into your main checking account, you're like, well, where'd that $10,000 come from? And you're like, oh, well, I just transferred it from my savings account, no big deal, right? But to a loan officer, it might be, or to the lender, it might be like, well, now we got to figure out where that came from because it can't be a gift.
Right. So yeah, we got to track all this stuff down, and it's doable, but it's just more work for you guys, more work for us, and it slows the process down, right? The more we have to document, the more has to be reviewed, the slower the review goes, so on and so forth. So my suggestion is, if you know you're going to be looking at buying a house in the next 90 days, we are going to always ask for the last 2 months of your bank records. So I would suggest when you're 90 days out and you're like, okay, I'm pretty sure that I'm going to buy something and I've got 9 bank accounts all over the place.
Yeah.
Move the money. Get it there so it's all in one place. Then your life is going to be 10 times easier when you're going through that transaction, and it will help speed up the process. Just moving the money all to one spot.
Okay, so when you make that decision, when you and your spouse are sitting down and you're like, we're going to buy this investment property, or we're going to buy this new home, or whatever it is, have your stuff, transfer it 2 months prior to when you know or think that you're going to be buying this property, right?
Yeah,
simple.
Totally.
Simple. Okay, that's a good tidbit right there. Anything else to help speed it up?
Buy a scanner.
Buy a scanner.
They're like $40 at Costco.
Yeah.
Buy a scanner. Save you a lot of headaches. Taking pictures with your iPhone become on tax returns and things like that.
Sure. Yeah, good idea.
But yeah, I would, being organized is probably the thrust of all of that, right? Is just having your paperwork and things really organized. But the bank statement one I've noticed can be probably one of the more frustrating ones too, because it feels like we're always asking for more and asking for more and asking for more. And it's typically centered around the fact that we've got multiple accounts and money transferring all over the place. And that's usually the reason why.
All right. So when you're out there shopping for a home to use the VA loan, first time home buyer, say, what should you be looking for? Knowing you're going to be using a VA loan, what are some tips that you can share with our audience about what to look for in a home?
Well, if you get to go actually inside and inspect it now, because this whole COVID thing, that can be a little bit dicey depending on your location.
That's the next question. Appraisals and inspections. Let's not forget that. But yeah,
okay,
go ahead.
Yeah. But I would be looking for structural things and safety related things as you're walking through the home. Not only does it fit your criteria, but just kind of keeping an eye out for that stuff, deferred maintenance related things, because all of that stuff has potential to come up on either your appraisal or your home inspection. And from a realtor standpoint, probably one of the greatest apprehensions they have about accepting VA loan offers is the VA appraisal, because if the appraiser says any particular item needs to be repaired or addressed, then that item has to be taken care of before you can close, which is a little different than a home inspection, right? The home inspector can say, hey, I kind of gave this one a might want to address thing later, and if it doesn't hang up the loan at all,
Mm-hmm.
You can address it or not.
But the appraiser specifically.
The appraiser specifically, if they call out something, then that has to be addressed.
Give an example, like wood rot at the bottom of every single door jamb on the exterior of the house, right?
Wood rot, that's a big one.
I mean, it's a simple fix, but it's enough of a pain in the rear to a seller sometimes for a seller to go, well, if I had an offer from somebody who wasn't using the VA loan, that they could take care of that on their own. But if you're using a VA loan, all section 1, it's section 1, right? Was what they call it. Termite, structural, pest, all that stuff that needs to be covered. So what he's saying is the inspection reports, by the way, are always 40 to 60 pages long. Like that's just the template. They're always that long. But separately, the appraisal is going to require certain things to be repaired. And if they come up as needing to be repaired, then the seller is then going to have to go fix them, not just as a credit at closing. They need to be repaired prior to closing.
Yeah.
Right. So that can be a hang up on people who are accepting VA loans as their offer. Now, they're not supposed to discriminate, right? But
no, they're not.
They have the ability to reject offers based on what they see.
Yeah, and I think, as the home buyer, if you have a good realtor too, like someone from, that we were connected with through ICC, through ADPI, then they know when they're going through the home with you, they're looking for these things anyways. But I know a lot of our group, they're pretty handy. They want to put some elbow grease into this place.
Me included.
Yeah.
Yep.
And so people like that might go walk through a home and go, yeah, I probably need to fix that over there. Okay, I could knock that out in a weekend.
Yep.
And that's kind of how your mind works. But the VA appraiser is going to go, oh yeah, that transition piece they missed from the hardwood floor to the carpet, that's a trip hazard. That's a safety related issue.
Right.
It must be repaired prior to close. And you're going, man, that's an hour and a trip to Home Depot.
Yep.
So you don't know unless you know, but they're looking for safety and health related things like just the cover around the light socket. It's less than $1 for the actual part and, a minute of labor. But that's a safety hazard because a child or somebody could stick their finger in there and get electrocuted, right? So safety related things, peeling paint is one I see a lot.
Because of lead, right?
Well, it can be lead and moisture.
Okay.
So,
I see. Yeah, because there could be underlying issues causing the paint to peel. Yeah.
Yeah, and moisture getting behind the paint onto the wood can then cause mold, and that's a health issue also. So, peeling paint is probably the most common one that I see, and so that's something that has to be repaired prior to close. And it always happens. We see the most of them during the winter. So now you've got inclement weather, and you can't paint because it's 20 degrees outside, and it needs to be 40 or whatever the temperature needs to be for paint to dry. So, so those are kind of some easy things you can look for. Smoke detectors is one, make sure it's got smoke detectors. That's a safety thing.
Carbon monoxide, right?
Carbon monoxide, yeah.
So I wanted to talk about this while we're mentioning real estate agents. I think that's important to note. Vanessa Noble is heading up our efforts on a national scale to make sure that we are really creating this huge network of agents that are focused on the military, but understand the mentality of you need to buy every property with the idea, at least, that there's a potential that the property can be a future investment property. Because me included, when I bought my first property, I wasn't looking at the 1% rule. I wasn't looking for paint chipping. I wasn't looking for, can I buy a fourplex and will it cash flow later on? I wasn't thinking of my single family house as a cash flowing asset. And so what we're doing now here is just like what you said, Jason. You got to have an educated agent who is looking out for your best interest, understands not only the VA loan, but the veteran and what we're looking for and how we move and how we talk. And so on a kind of a national scale, Vanessa is going to be doing, she has already started doing a great thing for our ICC, our Intercore Coalition, and our agent referral network. So look out for that, guys. It's about to explode, and it's going to be amazing because you're finally going to have not only AmNet, ADPI's American Mortgage Network branch, and Jason helping you guys out with your loans, but we also have the agents who understand this process and can connect all the dots for you live in person on these at these properties. So really excited to talk about that too, but that'll be another show. So Jason, I wanted to kind of say, as far as AmNet, American Mortgage Network, our branch of American Mortgage Network, why is it important for people to consider that? Obviously, we want people to shop around, right? But why is it important to consider American Mortgage Network? Why is it unique? Obviously, it's uniquely ours, right? In this community, and the amazing community that we've built. But why have we done this? Why do we have in-house lending?
Well, I would say, the biggest reason is we wanted to be aligned with people and a company that shares our same core values, right? And so, and I say this to a lot of clients on the phone too, it's all about your team, right? It's about the team you assemble to help you with your home purchase. And there's so many options out there. I mean, you go one click on Google and you can have like 9,000 lenders pop up with all the greatest rates, and everybody's an expert at everything, right? But how do you even really know, right? I mean, so, it was born out of the fact that we needed to create something where there was some vetting done for our members so that there was people available to them that would be advocates for them, right? More than just the sales guy or gal pushing the product or pushing a home on them, but someone who was actually an advocate for their best interest. I've talked a lot of people out of maxing out on their VA loan to buy smaller because the future plan was to maybe use VA loan again or to buy the next PCS move or whatever, even though the attraction of the maxed out scenario was really appealing, right? So, it boils down to that. And the unique thing about AmNet, that we call it, American Mortgage Network, we call it AmNet for short, is it's 100% employee owned. So we are all owners of the company, not just, this specific branch within the company. We all are owners in it. And that may not sound like anything to people at the surface level, but it's really important because in mortgage companies, and I've been in the mortgage business since 2001. And so I've worked at a handful of mortgage companies, and it's usually at most companies, the senior executives are controlling the spigots for everything. And when they determine they need, more profit, then they increase the margin on rates. And when they feel like they can be competitive, they turn it down. And when they feel like they need to make a change here or a change there, they just do it. And the consumer is the one at the end of that train getting wagged and taking the hit for it, along with the loan officer. So the design and predication of AmNet was really to be employee owned, so that it was truly a benefit to both the consumer and the loan officer, in the sense that there was no one up there controlling your future outcome with it, and to also provide a pricing platform that was stagnant. And what I mean by that is, like I just made the analogy with the spigots, so many mortgage companies, the ones you've heard of that are well-known names, they play with the margin, right? And that affects interest rate. And we have kept that flat. We don't play with that at all. That is flat. The market fluctuates, and so that's what makes rates fluctuate. But it's not our own internal dialing of margin. We've kept it very low. The operating costs of the company are extremely low, and we've done that on purpose so we can offer a great product to our clients. It's going to be an aggressive, very well priced interest rate, competitive with brokers, more competitive usually than banks out there. We want to be able to provide excellent product with great pricing, and that was really part of the reason that we all teamed up in processes and process flow and stuff like that.
Yeah, I love that. And for you, someone with 19 years experience, probably scary to even think that, huh? It's like, oh man, 19. But somebody with 19 years, somebody with that much experience in this industry to come over to AmNet from, you could be with any company and make great money as a loan officer, but you saw the vision, and all of our loan officers do see that vision, and we're always looking to expand, and there's no limitation on growth for us, which is amazing. I love that. And by growth, what I mean is no limitation on being able to help millions of more veterans and millions of more just people who need loans out there in a better kind of more controlled environment. So,
yeah.
Awesome. Well, let's wrap it up. I think that was a good start for this first one here. And I just wanted to say, give you any last minute thoughts you have on VA loan, where we're headed, or about AmNet, or whatever you want.
So I think we're going to remain in this low interest rate environment through the year. The stay-at-home orders are being lifted. We're going to start seeing PCS moves happening again. The one product, or two products I should say, in the VA space that are on ice right now, they're suspended, is the VA renovation loan and the VA construction loan. And it's suspended everywhere. It's not just certain lenders. And we don't have an ETA when they're going to come back online. We don't know. There's been no news on it. So until further notice, those aren't available. But there's plenty of great, model we have on that. But yeah, we're just excited to be able to get in front of everybody, share some knowledge. We're always here as a resource for you guys. So whether it's in the page or through ADPI Connect, reach out, man. We're here to help.
Just got a great question here. I'm going to see if I can ask you that. Let me turn down my phone here. I got this on. So recently just left another Facebook group that advertised vetted services, but I don't think they were as transparent about what was included in the vetting. As ADPI brings more services online, can there be something that states the standards a person must meet in order to be considered in our best interest? One of those, I will say, this is from Jim Sheehan. Thank you for the question. But one of the things is what Jason just got done talking about, and maybe Jim, maybe you just joined us, but which is the flat rates. We're not fluctuating based on what we want. The market can fluctuate, but Jason can talk a little bit, kind of rehash that real quick. But what else maybe another way to look at this is, what are we looking for in our loan officers that make them vetted? I mean, team first, being able to take a hit when necessary, to do the right thing for the team member at the right time, or for the client at the right time. But talk about that maybe for a second to answer Jim's question. And thanks for that question, Jim.
Yeah, really good question. So, and this probably speaks into how we're vetting realtors and everybody else too. Yeah. Part of it is we we want them to have some sort of connection to the military, whether they serve, they were a military spouse, there's some connection, there's some level of understanding what our membership is experiencing with moves and things of that nature, right? So that's one piece. I would say the larger piece of it is just moral integrity, right? I mean, my industry and the real estate industry is filled with people who are just chasing a commission check, and that's all they care about. Whether they had to step on their own mom to get there, then they will do it, right? And so we do a lot of interviewing to ensure against that, because we want to make sure we have high moral integrity. And next to that is experience, and not just a gazillion years of experience, but transactional experience, right? There's a lot of people out there that have been realtors for 30 years, where they've done one transaction every year for the last 5, right? That's not being practiced, right? Just like anything you want to be good at, you got to be practiced at it. So, we're interviewing loan officers, we're interviewing real estate agents. We're talking to them about their knowledge of the VA loan, the transactions, what their thought process is with, a young soldier or a young Marine that's trying to buy their first home, and
do they have the willingness to tell somebody not to do a loan that they're over leveraged on, right? Do not, right. or to, instead of trying to squeeze them into it, like you just did recently, is tell somebody, don't max out your VA loan. What are your goals is the first question, right? Vanessa, right. Who is building out our nationwide realtor network, that's the first question that she asks also. And Jason, I'm assuming you're the same, is what are your goals? Why do you want this loan? Do you want an additional loan? Are you going to house hack from base to base? I know you've seen people with 3 simultaneous VA loans. I've had 2 simultaneous VA loans. And I wish somebody asked me, what are your goals? Because then I'd have to start thinking.
Yeah.
Like, what are my goals? Hold on a second. I don't know.
Absolutely. It's funny, in some sense, if you have the investor mindset, it makes getting stationed at places like 29 Palms and stuff kind of enticing because, some of these less desirable duty stations might have lower priced homes, which is great because you probably haven't been able to use your tier 1 VA eligibility anywhere else. And boom, here you go. You still got tier 2. So yeah, now you're on pace to have 3 VA loans at one time, right? So you can kind of add another spin to it to make it exciting when you're going to a place you're not really looking forward to.
Yeah. Yeah. So, Jim, I hope that answered your question a little bit. It's just, partly is experience, military experience, understanding the language and experience of a military member, having integrity. And then also the fact that we're charging flat points, and you can talk a little bit, you did a little bit more about that, but the market is fluctuating, but we're not fluctuating based on what we need because our overhead, our operating costs are so slim, right. Which is unique to the industry.
Yeah. Yeah, I mean, and we're looking for that. We're looking for that knowledge, when it comes to the loan officer side of the house and even the realtor side of the house. Their knowledge on doing VA loans on multifamily homes and being able to properly put that together, calculate VA residual income calculations. Do they even understand what that is? So there's a knowledge threshold, and then also we also are asking about their process, right? Because the industry is so unstructured because everyone is kind of their own boss, right? So it's not like when you're in the military and you show up at a certain time and they tell you what to wear and they tell you where to be and all that stuff, right? When you go into civilian world as a realtor or a lender, that structure doesn't exist anymore. And so oftentimes when I'm talking to loan officers that are looking to come on board, I'm asking about their structure, not only from like a daily routine, but also their structure while they're in a transaction with somebody. What is the process? And I think for me, I can tout that that's one of the things that helps set me apart from my competitors is my process, right? And I'm structured with it, and it's rigid, and you can see it, but it's helpful, and it helps everyone in the transaction. So understanding that a lot of people, believe it or not, have no process. They just get a loan and they just start going.
Just ram through it.
Yeah, and it's just shooting from the hip all the time, but they've been shooting from the hip for 10 years, and they're awesome. And that may only work to a certain degree or only work for so many people. So we're really just trying to vet all of those factors out.
Yeah, that makes sense. All right, guys. Well, thanks for joining us, and we will keep on giving you updates, and we'll have a lot more content coming out soon. Jason, thanks for your time today. And ADPI, I want to say to you guys, determine what it is you want. We talked about goals a little bit, but whatever that thing is, please get out there and get engaged with our group, because we have 16 free resources. If you want to learn something, we've got courses, we've got free modules, we've got our #1 best-selling book that's free, Military House Hack. You can get that on our website also. But just get engaged, because if you can just start from the beginning, learn something in order to get 1% better every single day, action piece by action piece, then success will hunt you down, okay? It just takes that one step every single day. So whatever it is, if you need a loan, if you need a real estate agent, if you need insurance, if you need education, we've got it all right here. We're glad to serve you. That's why we exist. We are passionate about this, and we will never stop until we are able to help millions and millions of veterans. So thank you for all you do out there. Jason, thank you again. And ADPI, make sure that you take action. Talk to you guys soon.